Oh, we've got a dirty video to talk about here, but first, I want to remind you that if you want to get pro pricing with Lowe's, make sure to join the Zero to Millionaire Real Estate Investing course, the Do-It-Yourself Rental Renovations or Property Management course, linked down below, and you'll get access to our Lowe's partnership, so you can not only pay for all of the knowledge in the courses to make sure you can build wealth with real estate, but you can take advantage of better pricing at Lowe's. Check it out, link down below, and make sure to bundle it with that Lowe's credit card. Not sponsored by Lowe's. Let's get into the video. Well, if you were in doubt that home prices are falling, have doubt no more. In this video, you're going to see exactly which areas in the United States are having the most pain, even though year over year, the Case-Shiller index, August to August, mentioned a 12.99% growth in year over year price appreciation. We are officially seeing the turn, with a now 1.3 percentage point month over month decline from July to August. And boy, you're gonna wanna see some of this data, because that, folks, is a big inflection point. It might not sound that large because, hey, if you're used to stocks, okay, you're used to large numbers, okay? 1.3% though rivals the monthly declines that we've seen in the 2009 great real estate crash, 2008, 2009. It took all the way until about November of 2011 for the real estate market to bottom out. I know that because I was part of the bottom of the market, not only as a buyer, but also as a real estate agent and eventually a real estate broker. So let's talk about why this is important, because look, when you hear that, hey, well, come on, man, year over year prices are up 12.99%. How is that a housing problem? Well, it's not. I mean, it's a problem if you're trying to afford homes, but it's not really bad, right? But you're sticking your head in the sand if you believe that prices going up 12.99% over a year. So if we kind of compare this August to last August, we're like, oh yeah, that's 12.99%. Wow, great, things are going up. Sure, but what happens when we start seeing this? And all of a sudden we see, oh no, in the last month we've declined 1.3%. Well, now you have what's known as an inflection point. And this inflection point today is brought to us by the CoreLogic Case-Shiller index, which notices a, quote, continued deceleration of the real estate prices and leading measures of home prices, suggesting that data could get actually worse substantially before it gets better. Now, this is really critical because housing is something we absolutely want to pay attention to because it affects every part of our economy. In fact, a lot of housing-related stocks are actually still not suffering because the housing market is still sitting on a lot of equity, okay? You need 15% declines for the first, or I should say for the people who bought homes within the last 2 years to lose 2/3 of the equity that they've built. You need prices to come down 15%. Put another way, since that might sound a little confusing, anybody who bought a home since the start of COVID is sitting on so much equity that prices could come down 15%, and they still have 33% of the equity that they had before that. That's crazy. So if you had 100% or $100,000 of equity because things just ballooned and then you lost $67,000, you'd still be up $33K over what you paid, right? That's almost enough to pay some of your selling costs in case you wanted to get out. But the point is, the trend is not your friend in this case. And unfortunately, housing is very slow, oftentimes lagging the bottom of the stock market by 2 to 3 years. And this is why I've created a startup house hack to make sure we can capitalize at the bottom of the housing market. If you're an accredited investor, learn more at househack.com. If you're not, you could also learn more, but you'll have to wait until January, February before you can invest. We have a deadline coming up, by the way, on October 31st. Big deal. Get in before those free call options, well, their warrants, expire. Learn more about this by reading the solicitation at househack.com. But we have to understand which specific markets are getting hurt. Are these blue states? Are they red states? Are they blue-red cities? What's going on? And how does this harken back to 2009? Well, remember, the highest rate of monthly declines in 2009 was 1.9%. The stock market bottomed out in about February of 2009, and the real estate market bottomed out in November of 2011. And now we are in 8 months in a row of home sales declines, with now officially home prices falling across the board. This was not the case last month. So this is the first month that we actually have across the board real estate declines. Let me go ahead and show you the actual data. Here's the data directly from the Case-Shiller report. What I've done first on the left side is you can see metropolitan areas here, top 20 cities that they sort of track. And on the right side, I want you to pay attention to this circle I'm drawing right here. You see all these sort of green highlights I made? The green highlights over here represent positive sort of growth in real estate prices. Well, over here in this red box, I shouldn't have used green again because those now represent small declines over here. But every single city in this red box is now negative. Whereas over here, about, 8 of them were still positive. So 8 out of 20 were growing over here. And now all of a sudden, all of them are red. Every single city is now red. And I'm not talking about politically red, okay? I'm talking about price appreciation down in the gutter. And if it stresses you out, don't worry. metkevin.com/life insurance. You could sign up in as little as 5 minutes, Apple Pay or Android Pay for it. I even have an Android phone now. How cool is that? I've never had an Android phone before. I got an Android phone now. I got to plug it in. It's at 5% battery. Anyway, so let's look at some of the biggest declines here. Atlanta, folks, 0.4%. Not that big of a deal. Where are we getting hit the hardest? Look at the red highlights. It's the West Coast, folks. Phoenix, which isn't really the coast, but it's more west than Florida, obviously. San Diego, super Democrat, right? San Francisco, uber Democrat. Seattle, very Democrat, 3.9%, 4.3%, 2.8%. Now, I don't necessarily think this is an argument about politics. I do, though, think that these are areas that blew up on the tech bubble, which tends to be a little bit more democratic. So again, this has really, I think, little to do with politics, although there are folks who are going to draw that parallel, especially Republicans, that are going to be like, of course, it's the blue states getting screwed. Don't worry, everybody's getting screwed, so you got your coming too. But anyway, the point here is these are markets that really got hot really fast during that sort of tech bubble. Tampa actually only down 0.5%. I've got some great connections to Tampa. I've met so many wonderful people over the last few months in Tampa. We've got Miami. Look at that. Only down 0.1% as you've actually got foreigners still coming to Miami to park money in Miami because they believe their money is worth more in potentially depreciating real estate in Miami than it is in El Salvador's Bitcoin or in Brazil or Venezuela or Cuba or whatever. And I mean, you can't really blame them because Miami is freaking awesome. You've got not that Citadel is awesome, but you got Citadel spending probably somewhere around $1 billion building an office complex down there, moving developers out there. Kathy Wood moved down there. Miami's awesome. I was just there. I went on the Anthony Pompliano podcast. Dude, great guy, okay? I've invested with him before in private capital, private venture capital. Hey, maybe he should invest in House Hack too. I should hit him up for that. But anyway, great guy. Go check out the podcast. It was a fun podcast. Anyway, look at some of the other declines here, okay? Negative 1.9% Dallas, Denver, negative 2.3%, Los Angeles, negative 2.3%, Vegas, negative 1.2%, Atlanta, Chicago, these areas holding up, only about 0.5% declines here. Detroit, I didn't know prices could get any cheaper. If you want to see some cool videos, type into YouTube, Meet Kevin Detroit Fire and Meet Kevin Detroit. Okay, really amazing videos. Watch those videos. You'll love them. I promise you will not regret the Detroit videos. Maybe not necessarily the fire one. The fire one is more entertainment, but it kind of shows you what goes on out there. It's very sad. And I guess I shouldn't call it entertaining. That's pretty insensitive. But it's less educational than the other Detroit video, okay? Gosh, man, you gotta be so careful about what you say these days. Maybe if I had an editor, this wouldn't be that big of a problem. Oh well. Anyway, so yeah, let's take a look at this because these things hurt. Because when you look at non-seasonally adjusted versus seasonally adjusted, again, on the June to July levels, you have lots of green over here that is still positive. Everything over here is now red. I want to clarify again that even though I stupidly used green highlighting over here, nothing over on this side is green, so ignore that. 10-year Treasury yield. Now, this is remarkable, okay? Because this report is from August. This Case-Shiller report is from August. Now, why that's really important is because when you actually look at the 10-year Treasury yield, which is obviously what mortgages relatively closely follow, this is where we were at the end of August, okay? So August really benefited from almost what was deemed a trough over here. In fact, if you kind of draw a circle around over here, you really have a low era here of rates in late July and August, early August. August, you had low rates and they were just starting to rise again. And that era ended right here where that red X is. And unfortunately, since then, well, folks, I mean, you could clearly see the trend here, and the trend again, not your friend right now. Although in the last couple days, it has come down slightly, especially after that Google earnings miss. We've come back down to just under 4.1%. But honestly, I wasn't expecting it to cross 4%, and there are a lot of people calling for it to go to 5%. So, oh dear. Here's just graphically how you can see on some charts, you've got areas starting to inflect down. This is kind of similar just to what I've shown you, even Miami showing the inflection point down, Tampa showing the inflection point down. Here's sort of some more supporting data on the indices overall moving down. But I think one of the interesting things to look at is one of these comments here. The forceful deceleration in the U.S. housing prices that were noted a month ago continued. Given the continued prospects for a challenging macroeconomic environment, home prices may well continue to decelerate. Yeah, decelerate is maybe the word that you could use now when you're looking at year-over-year numbers. In other words, a slowing appreciation. But don't worry, they'll be going in reverse pretty soon because, well, they already are. So that's not even financial advice. That's just being obvious. They're going backwards. Prices are going down, which maybe creates an opportunity for you to get into real estate at some point in the future. But the problem is it's harder to qualify for a home. So if you want to know all the tricks of the trade, that is from somebody who's been doing real estate for over 12 years, not only as a real estate broker, but as a real estate investor. I was a licensed lender at a time, a licensed contractor at a time. You want all of that experience in one bundle, licensed property manager, you name it. Go check out the Zero to Millionaire Real Estate Investing course. There's a Halloween coupon code link down below. There's also a Do-It-Yourself Property Management course with rental renovations guide. Very important, so you stop overspending and join our Lowe's for Pros partnership that we have there as well. Thanks so much for watching, and we'll see you in the next one. Thanks. Goodbye.